It's time for Hot Picks. Our guest frequently joins us on ETFs. Today we're going to focus on exchange-traded funds in the gold sector. We are joined by Mike Philbrick, CEO of Resolve Asset Management. Mike, it's great to see you.
Great to be back.
Just give us your thought on gold ETFs generally before we get into these examples.
Yeah, right. So I think that what we have at the moment is an opportunity for gold in portfolios. And we've been talking about this over the last year, but it's becoming more relevant as investors have seen returns in gold of 50% in Canadian dollars, 60% for gold stocks, and 80% for gold junior miners. Mm-hmm. And so something is afoot here. We have central banks buying gold at record paces, continuing to grow. So they started after 2008. It was amplified after the invasion of Ukraine by Russia. Mm-hmm. And then further, you have this global debt that's on an exponential rise. And then finally, you have erosion in the confidence in our very fiat system. Mm-hmm. All of this is leading to a more persistent bid for gold. And so now let's talk to investors about how do I get this into my portfolio.
Your first idea is MNT, Royal Canadian Mint, Canadian Gold Reserves. And technically, it's an exchange-traded receipt.
Correct. And this is why it gets the nod here, because the ETR is a little bit more directly related to the investor who owns that unit, actually owns gold tracked right to the mint. Okay. So it's a slightly superior ownership structure to, let's say, GLCC, which is the iShares Gold Bullion, where you own the actual ETF. Mm-hmm. Now, honorable mention to CGL/C, right? If you own that, it's great. It's got a little bit higher management fee, a little bit less of a structure, maybe a little bit better for trading or big size. But MNT gets the nod here for, holding gold bullion in the portfolio. I could take delivery if I wanted to, and getting access to that in the portfolio.
That's interesting, as opposed to holding gold bars and hiding them under your bed.
Correct.
Which
you have to reintroduce into the system, and who knows who's going to break into your house. And if they have a gun and you have gold, well, your gold is theirs now.
Okay. Number two, this is an ETF that tracks gold miners, but it's Correct. A covered call version.
Right. And so I know how investors in Canada tend to like to have a little bit of income in their portfolio. And so covered writing gold stocks works particularly well because they've got lots of volatility, so you get a pretty good premium. But we also want to keep some of that upside. So the key here with the Global X Gold Producers Equity Covered Call ETF is that it only writes a portion of the portfolio, and it's dynamically written. So they can write a little bit more if they're more bearish, they can write a bit less if they're more bullish. Mm-hmm. And so this gives you exposure to the large cap stocks, which gives you a bit of gearing right there. You take a little bit of that leverage away by selling some calls and creating the income. The income's around 9%. Also here, I want to give an honorable mention to AMAX. That's the Hamilton Gold Producers Yield Maximizer. Again, the products are very close, small nod to GLC for maybe a slightly more dynamic covered writing process, but pretty close. If you owned one, you wouldn't sell to buy the other. Just good positions to be in to create some income and get some exposure to gold through the big cap gold stocks.
And then finally, you referred to the gains in junior gold stocks, right. And this is a way to play those, ZJG.
Right, this is the BMO Junior Gold Index. And here, the junior miners historically have more beta or more leverage because they've got more debt on their balance sheet, their exploration, they're trying to find more gold. Sometimes they get bought out by the large producers. So they provide more gearing or more exposure. Also more volatility, so make sure you're ready for that in the portfolio. But we are starting to see that pervasive performance through the whole sector, right? Starting with the gold itself, large caps and small caps. So if you want a little bit more gearing and you're taking a little bit more risk, that is a place to go. Again, here an honorable mention will be Long Point's ETF. So Long Point has launched a number of new ETFs, and they call them mega longs because they're 3 times levered. And this one is the Canadian Gold Miners Daily Levered ETF, CGMU. So if you want that gearing and you're more apt to maybe do a little bit of trading or monitor your allocation, so when it runs up, you trim it, rebalance it. So if you're active a little bit more on the trading side, that might be something to consider. But there's the 3 kind of ways in which you could get exposure to the gold and gold markets as we're in this bull market. And I think we're only in the 4th or 5th inning on this bull market.
Thanks for drawing our attention there to the BMO Junior Gold ETF. I hadn't realized that it had done so well. It's up about 74% in the past year.
Sneaky.
And and if you look at, say, GLD in the US, the big US ETF that tracks gold, it's up less than 45%. So certainly.
Some of that's Canadian dollar, because if you look at MNT, MNT's up about 50%. So call it 45 to 50 in the metal itself.
Yes.
But that small cap gearing that you get from those smaller companies, it wasn't evident in the first sort of 3 innings of the gold price running. They weren't participating. But come sometime mid last year, they started to really gain hold because you started to have to make adjustments to what you're going to discount those future cash flows in those businesses at a higher gold price. And when that happens, earnings go up, the opportunities go up, valuations go up, and so prices go up.
Yeah, we might have BMO on to talk about the juniors in that ETF.
Great idea.
Mike, thank you very much indeed.
Thanks for having me.
Mike Philbrick, CEO of Resolve Asset Management.